Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by my company, Bull Realty. We're commercial brokers in the Southeast U.S. If you're a lender, borrower, if you're an owner, whatever you want to sell in the Southeast U.S., we have about 50 folks. We have people in every sector. Give us a call. My email's an easy one. It's michael@bullrealty.com. Call or email. Let's get to our show. You know, a lot of the questions I'm hearing today from clients and customers, and when I speak at events, is what's going on? What's the future look like? Some of the questions revolve around the one big beautiful bill. What's that mean for the economy? What does that mean for commercial real estate and our users, our tenants? What about tariffs? We just had some more deals happen. Big one with Japan. What's that mean? What's happening there? I think we were all a little, how would I say, concerned about the tariffs, how big they were in the beginning, but where are we now? And then rates. It seems like we're back to more historic normal rates, but I know we all hope for some reductions down the road, but will we get it? What could it mean? Well, let's find out. Please welcome my guest. It's Tim Bodner, and he is global real estate leader with PwC, where he's also a partner. Tim, good to see you.
Nice to see you, Michael, as always. Thanks for having us.
Yeah, thank you. And let's talk about the one big beautiful bill to start us out here. Is it really that beautiful? What's your overall take on it?
Well, listen, certainly, the one big beautiful bill was a core pillar of the administration's agenda that had, introduced into the market a fair amount of uncertainty. And so certainly having that passed and knowing what's in it is a great thing, not only for the real estate industry, but also for the overall economy. And the fact that we got it relatively on time is even more surprising, just given what's going on. Incidentally enough, when we think about the bill itself and the impact on real estate, what's in it is certainly helpful, but what we think is actually more helpful is what didn't end up in the bill. If you may recall that early in the process, they were talking about limiting the deductibility of business taxes. They were talking about reforming carried interest, like-kind exchanges came up at various points in time. There was also the Section 899 section that would have been applicable to certain foreign investors, and none of that made it in to the bill. And so actually those are really the more notable points in our regard that we think is really going to has put the real estate industry in a really good spot. So that's how we would kind of characterize it from a high level, Michael.
Yeah.
At this stage.
Yeah. And that's a good point. What didn't happen in there? And I know there was some fear about that, about almost all of those items, and that's a real good point. What about the bonus depreciation? What's the impact there, you think, on business generation for companies and for the real estate world?
Yeah, we've indicated in our outlooks, both here in the U.S. and also globally, that we believe that there's going to be more real estate investment in and around kind of what we consider to be new economy assets, and part of those new economy assets are tied to the reshoring of and alteration of supply chains, and certainly capital investment. Anything that spurs incremental capital investment is helpful to that, and bonus depreciation is one of those.
Yeah, I mean, there could be some real tax advantages right now of even in that first year of your business or the real estate acquisition.
That's right.
Yeah.
Yeah.
Yeah. Very advantageous. Well, let's talk about tariffs, because, that's something that, early on was really concerning people. There was some pretty big tariff numbers being thrown around. But here we are toward the end of July almost, and we just had a big announcement with Japan, right?
We did. And look, trade We talked about tax as one pillar of the administration's agenda. Another pillar of that agenda, as we understand it, relates to trade. Tariffs are certainly part of that. I think when we looked at this from our perspective, the tariffs were a mechanism that was being used in order to engage various countries around the world in a conversation that was ultimately focused on making trade more balanced and fair. And so when you think about trade in its present form, there's things that like tariffs that are oftentimes focused on, but there's a lot of other things that are in place around that are non-tariff barriers that actually have the effect of constraining or inhibiting trade or making trade unbalanced. And so the administration was ultimately focused on resolving the overall picture, and tariffs was one part of that. Our view was that over time, as these conversations occurred, that we'd see tariffs, settle at kind of a more normalized level. To your point, it certainly feels like that's where we are. We had the deal with Japan recently announced. There was also in that announcement, reference made to one with Europe forthcoming, and a series of other trade deals behind that. So it certainly feels like as we move through the summer and into the fall that we're going to see more deals announced. They're going to further reduce uh, the uncertainty that's out there around trade and tariffs. And at the moment, it feels like this is all being done without creating, a lot of incremental inflation in the economy and disruption to the labor market and things like that. And in fact, I think if you look at it holistically, the economy's in as we've worked through this is in a fairly good spot at this stage.
Yeah, and that seems to surprise some people, right? Who thought maybe we'd have a lot of inflation, and some people are even using the recession word in the beginning.
Yeah, and interestingly enough, I think we've been talking about the prospect for a recession happening for some time. We continue to have that conversations across our different businesses. There was some even this week that were focused on the yield curve and the relationship with the two and the 5 year and how that portrays or predicts a recession in the future. Look, there's always the prospect that something could happen that could trigger a recession that's out there. There's a lot of things going on in the world. It's a highly complex environment that keeps everyone on their toes or warrants scenario planning and other things. But I think if you kind of look at it objectively at this stage, we don't see anything at this moment that would suggest that a recession is coming. In fact, we think there's more things indicating faster growth than slow growth.
Whew, good, 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 good. That's good to hear, right? Um, when you look at the one big beautiful bill, and you look at the tariffs, you're the global real estate deals leader there. How do you think at this point the rest of the world is looking at the U.S. as the U.S. economy and investing in real estate here?
Yeah, I think what could be surprising to some, Michael, is that I think there has been a lot of dialogue and concern around kind of the relationship of the United States with other countries around the world. I think what we've seen in our business is even in spite of those conversations, we've seen significant capital being deployed here into the United States, in particular from places like Asia, the Middle East, and even Canada, for that matter, among some of the larger institutional investors. Certain sectors are more active than others. We can certainly talk about some of those. But the other thing that we've spent a lot of time thinking about and we've spoken about in part in some of our outlooks, including the most recent ones, is when you think about that capital deployment activity by these countries around those into those emerging sectors, it has the ability to create even more adjacent real estate opportunities in places like multifamily, retail, and hospitality. So, when we look at it and what we see so far is it feels like there's a lot happening. There's a time delay, there's a time element to how quickly that happens, but it's certainly the pipeline is there, and it feels like it's got there's a greater likelihood that it increases pace versus decreases at this point.
And is the America First, Trump's goal there of America First, is that helping kind of the potential future of our economy and of commercial real estate, and I guess of foreign investors' interest in owning real estate here?
I think look, if you break apart that question, I think if you're an allocator of capital and you're situated anywhere in the world and you look at the United States, it is by far the largest market in the world. It's got the best rule of law around it. It's the most liquid market. And so capital allocation strategies necessarily will continue to include some portion into the United States. The relative percentage can move around, uh, but certainly, it's top of everyone's list. With respect to America First, the policy administration, as we understand it, is not America only, but it's to create a more balanced uh, supply chain environment where more of kind of the things that are really viewed to be critical to our economy and to our national security, there's more of that that's made here in the United States than less. As that activity continues to happen, it's good for some cities around the world that have been going through periods of a more challenging environment, and it's good for real estate holistically when you look at it. So yes, we do think that as the United States and productions more focused here in the United States, that's good for real estate holistically as well.
Yeah. And there's, of course, been a lot of talk with everyone and a lot of use of AI. And President Trump has been working on that lately as well. What do you think the impact there is on in U.S. economy and commercial real estate and maybe jobs?
So listen, when we look at the AI topic, the natural place that conversations most often go is the data centers, and certainly the tailwind that AI puts around data center related infrastructure and adjacent asset classes is quite significant, and it's profound, and there is a long tailwind behind it. But I think what's also important to talk about when we think about what's happening around kind of the new economy assets, data centers being one, but it's much broader than that, is that even outside of AI, there's very, very strong tailwinds. If you just think about the amount of data that we're producing on a daily basis, the number of connected devices that we have, the continued proliferation of goods online, the importance of speed to delivery. All those things, are part of the same conversation with AI and put the real estate industry with some pretty strong tailwinds behind it, particularly in those areas that we would think about as kind of new economy related assets.
Yeah. Tim, what would you share with our audience related to advice or opportunities in the current market here as we get into the second half of the year?
So we like to kind of think about kind of where we think capital is allocated. It being going to be allocated in a couple different categories. First, residential related themes continue to be an area where there's supply shortages. We have a significant shortage of affordable housing. We've spoken about that in prior shows, but it's broader than that. It gets into student housing, manufactured housing, and anything kind of residential related. We think that's going to be a continued area of focus where capital go. We encourage people to look there. Second would be everything that's happening around sports and live entertainment. We've mentioned this in our outlooks for a period of time now. It's continued to amaze us how fast that theme is growing all around the United States. And a lot of that activities focus on kind of more of the professional sports, but it's much deeper than that. It gets into collegiate sports, it gets into youth sports, and the creation of mixed use entertainment districts with multiple different asset types around it is an area of growth. We'd encourage people to kind of focus there. We think there's some really interesting opportunities for consortiums to partner who are specialists in certain areas to make an overall district work. So that's an area. Wellness, listen, the when you think about the trends in longevity here in the United States, the changes in consumer preferences, the amount of activity around wellness is profound. The Wellness Institute, some of your readers or your listeners might be familiar with, just issued a recent report on this. The wellness real estate industry is the fastest growing part of the wellness economy, which is a pretty significant indicator of what's happening. And then these new economy opportunities are also areas to pay attention to. So those are the kind of the four, and from a macro perspective. Having said that, listen, we continue to see really interesting things happening in retail. We've spoken on your show for years about what's going to happen with retail. I think we're finding out what's happening with retail, and it's actually seems to be a pretty sunny picture at this stage relative to kind of where some thought we were going to end up, and I think we were all a little nervous about it. But there's a lot of opportunities in retail, and we're seeing more and more happening in office. So these kind of other areas, retail, office, that were kind of more forgotten sectors, I think our perspective would be that you should keep a close eye on those because there's some really interesting opportunities that come up from time to time, including I think some things that you were working on that we were talking about shortly before. So I think that's kind of how we look at where we are at this stage, Michael, towards the end of the summer.
And Tim, how do you look at new supply and starts? We're just taking out a 289 unit Class A apartment complex, and I looked at starts and deliveries, and it's been extremely high for years. I mean, from 21, 22, 20, and then now we look at new supplies, and it's just dropping off a cliff. It's like stopping, and with no new starts really in sight. And when we talk to developers, they say, yeah, we're having trouble with materials cost and in getting them, and then tariffs have helped, and we're having trouble with labor. And look, the immigration policies haven't helped. Interest rates, the interest rate spike isn't helping. What could be the potential impact of the performance of some of these commercial properties when there's just limited new supply hitting the ground?
Yeah, I mean, the supply point, Michael, from our perspective, is one of the key differences of this cycle versus some of our prior cycles. In that, as you just eloquently said, there really is very little new supply happening, really in any asset classes, and in fact, in the office market, we oftentimes hear people say there's a shortage of kind of office assets that meet what folks are looking for today. So the supply picture is good for existing owners of assets. It does have some indirect impacts that we're going to have to figure out how to work through because as we've talked about, particularly in the residential related things, when you have a shortage of supply in a sector that already has a lot of affordability issues, that is not helpful to that. But for the foreseeable future, it feels like supply is going to be very low and it's going to take a while for it to turn around.
Yeah. Well, it seems like if the Fed's looking to control, cost on things and inflation, and they care about the protection and power of these banks, that hey, why don't you lower the Fed rate, right? If we can get interest rates a little lower, it could help housing get built. more housing get bought cheaper, and also I think almost any drop in rates could help the banks a little bit on these maturities. Most of the clients we talk to feel like we're more historic normal rates and don't really expect rates to drop much to make that big of a difference. But what do you think, Tim? What do you expect moving forward, at least through the end of this year, as far as rates go?
Yeah, it feels like the momentum, Michael, is that rates are going to move lower from here. Certainly, that's true on the Fed funds rate. There's a lot of other factors impacting the 10-year around trade and tariffs and currencies and things like that. But I think the way you framed it is kind of also consistent with how we ultimately think about it, in that what was most surprising to people and what hit the industry so hard was the how fast rates moved higher.
Hmm.
But at an absolute level, the rates are not that high. And so I think folks are realizing that, as you said, that we're kind of in this more normalized environment over a long period of time. It's more likely that we kind of stay relatively within this range. And the focus is shifting from that, or solely being rates focused, to focus on how are we going to create value in these assets moving forward from here. And some of that's causing a reorientation of capital to sectors that we consider to be more operational in nature. Some of the things we've already talked about, healthcare is another one you can think about in that regard. So some are kind of approaching it through changing the mix to more operational assets. But even in those sectors that are not, uh, as operational in nature, we've seen for some time a lot more focus on what's the underlying business plan and how are we going to drive the operational value or value at the asset level in order to achieve a level or threshold return that makes sense for our capital. So that focus on value creation is where we think there's a lot more focus than the absolute level of rates, because as you've appropriately said, we're in a more normalized environment. But of course, sure, people would love for that to go lower uh, if they have them. But there's a lot less focus on it today than we had been seeing.
Yeah. Had a potential seller ask me yesterday, "Well, Michael, what's my property worth today? And what's my property going to be worth in a year?" I'm like, I know what it's worth today. I can tell you what it's going to bring, and a pretty close range of what it's going to bring. But a year from now, I don't know. You don't know what's going to happen in the world. You just don't really know. And so if you can make a profit and move forward and do your next deal, your next development, your next value add, maybe you should move forward. And it seems like a lot of folks are doing that, including some of the banks. What are your thoughts on the banks and their position out there today?
Well, listen, we just you have seen the earnings for the second quarter start to come out this week among the large financial institutions, and they looked very strong based on what we've seen thus far. If you move down a tier to kind of some of the more regional banks, which as you and your listeners know, is a big part of has been a big part of the industry. The overall mix of originations into real estate is lower than it has been, but there is origination activity happening. It's been happening. The life companies are very active. The CMBS market is incredibly active. Now, some of that's related to the most high quality assets, particularly the single asset, single borrower market. But nonetheless, when you look at kind of the full landscape of the real estate finance markets, they seem to be in a reasonably good spot. The banks seem to be in good shape. There's some things happening on the regulatory front that could be helpful to that. Things around supplemental leverage ratio and the like that's looking to be adjusted by the banks. There's, I think, mixed views on how helpful that would be, or if it would actually be unhelpful. But nonetheless, there continues to be some things happening on the regulatory front to reduce the amount of capital that banks need to hold. If some of that happens, that could add, incremental tailwind to kind of finance activity. So big picture, it feels like the finance markets are in a good spot, which is a welcome relief because, as you mentioned, we also have this maturity wall that we still need to fully deal with. There's still a lot out there that needs to be worked through.
Yeah, good point. And for all the lenders and banks out there, I would tell you, my opinion, these probably some of the safest and best commercial real estate loans I think you'll do. When you look at the lack of new supply, if you're loaning on existing assets, in most cases, they're probably going to perform really well. So I say get out there and do your loans and build relationships too with the borrowers today. I know during the Great Recession, and I didn't think it was that great, but I had a one of the big banks come to me and say at the worst part of the cycle and said, "We want you to pay us off," and I'm like. Well, that'd be pretty difficult right now. And my building's in perfect condition. I have excellent credit. I have strong income. And it's not matured. It's current. Well, we want you paid off because they said to pay it off and 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 a lot of the listeners probably know the lender I'm talking about. I won't mention them, but uh, but that they don't like office right now either. But at any rate, they another lender came in and just said, since it's you, Michael, we know it's a bad time. All of this. We're going to give you the loan. And I think for lenders today, you can really build some relationships with good, strong sponsors out there by getting it and then doing these loans today.
So I've very well said, Michael. There's a lot of good deals out there to be had,
Yeah.
and we're certainly I think if you look at it, we're definitely in a recovery cycle for real estate across the board versus going the other direction.
Yeah. And then when you talked about the different property types and sectors and opportunities, very well said. I think those are all great opportunities. And then you touched in on office, and some of the office is doing fantastic, but still there's a good bit of distress. And I think therein lies a lot of opportunity. If you're a contrarian investor, there's been some reports out lately that suggest that there'll be more office removed from the market in 2025 than delivered, and that's pretty amazing. So in markets where you're going to have some natural demand growth, that could be a remarkable opportunity. Yeah.
Totally agree with that, and the office activity in the pipeline. Another public to private transaction was just announced actually today, and we continue to see activity back into the office sector among family office investors in particular here in the United States, but also the large institutional investors are looking around for the reason you mentioned. There's a lot of compelling value opportunities out there that could be overlooked without paying close attention to it.
Yeah, I agree. And I heard some lenders said we're not doing office. Well, wow, that may be some of your best loans, perhaps, and especially the way the some of the folks are kind of realizing that there might be opportunity. We just took out a large office tower that'd been on the market with a national firm for a year or two. We took it out and sold it in 2 weeks at full price, all cash. I mean, I think there's opportunity out there. Well, Tim, what would you leave our audience with to think about related to the big beautiful bill, or tariffs, or rates, or opportunities right now?
Look, I think number one would be continue to pay attention to the administration's activities and agenda. There's likely to be more changes on the horizon related to refining some of what was in the one big, beautiful bill and then incorporating other areas. The second thing would be that we continue to see a lot of compelling investment opportunities here in the United States and around the world, both in the traditional sectors like office, retail, like as well as these kind of newer areas that I was referring to earlier, which for some might not be a good fit because at the moment they could be perceived as more niche. But when we look at the tailwinds behind them, they're quite compelling. And then finally, I'd sum up with, I think what we're seeing is what we've you know uh, talked about on your show, Michael, and in other forums, is that that for us the real estate industry continues to be agile, creative, and adapt to the environment that's put in front of us. And we think that's going to continue to happen, and that we're up from here for the industry overall.
Yeah, well said, Tim. Great information as usual, sir. Thank you for joining us.
Thanks for having us, Michael.
All right. I'll add my advice to the end of that. Buy now. Buy now. Thanks, Tim, and thanks to you around the country for listening. Thanks for sharing the show. Please connect with us if you have any advice or need a professional for anything in the U.S. for anything related to commercial real estate. I'll be glad to try to point you in the right direction. My email is an easy one. It's michael@bullrealty.com. Don't forget, you have the C5 Global CCIM Summit coming up in Chicago. That is an incredible event. Check it out. It's c5summit.realestate. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. By the 2025 C5 Plus CCIM Global Summit, the premier commercial real estate conference for networking, deal-making, and investment. For more information, visit c5summit.realestate. For more podcasts and videos, subscribe and visit creshow.com.